You often hear that whole life insurance is a lousy investment. And that's kind of true in the sense that life insurance isn't an investment. Investments inherently have risk, and that's not the case with the whole life insurance policy. Today, we're going to talk about the internal rate of return of whole life and the external rate of return of whole life. So stick around to the end of this video. Hi, I'm Olivia Kirk.
And I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, please be sure to subscribe to our channel and hit the bell to be notified when we upload new videos. So let's get started. First of all, with a whole life insurance policy designed for cash accumulation, you could expect to earn anywhere between 3 and 5% over your lifetime. But understand, that's not how the policy starts off.
It's sort of like starting a business. If you were to start a business today, you wouldn't expect to become profitable in the first year, the second year, or even the third year. But usually from the fourth year on, that business will become profitable and hopefully will continue to grow year over year. And so it is with a whole life insurance policy designed for cash accumulation. In the first year, you might have access to 40% of what you put in. In the second year, it might be 60 or 65%. In the third year, 90 or 95%. But from the fourth year on, you should be generating a profit year over year in that policy, and it will only get better from that point forward because of the way the policy is designed.
Like we said, life insurance isn't an investment because there is no risk. Once that money is credited to your cash value, that value can never go down. So basically, when you pay your policy in the fourth policy year, if you paid $1, you could expect your cash value to increase by more than $1. And on a cumulative basis, we would expect the break-even point to be somewhere between year 7 and year 10. So for example, if you paid $100,000 in premiums over 10 years, you would expect your cash value to be $100,000 in those 10 years. And maybe a little higher. And then after that, the cash value and the accumulation value will continue to grow year after year.
That's right, Olivia. And the key here is that the so-called financial experts will judge life insurance on those first 10 years and say it's a lousy investment. But what they're completely ignoring is the fact that you could still access that money through the loan option or the loan feature in the policy. And that will allow you to not only generate that internal rate of return, but to generate an external rate of return on that capital, making all of your other savings and investments much, much more efficient.
Exactly. So you have that internal rate of return that isn't going to be interrupted by accessing that cash, and you're able to put that money somewhere else to make an external rate of return on an actual investment. So let's take a look at some of the ways our clients have used their policy in the early years before that break-even point. A great example is a lot of times people have debts on credit cards and they're paying a high interest rate, and it's taking up a lot of their monthly cash flow. An example of how you could use your policy is to repay that credit card debt using a policy loan and then rebuild and replenish your cash values so then it's accessible again in the future.
So basically, you could take a 15% credit card interest rate, borrow money against your cash value in your life insurance at 5% interest, pay that credit card off, and then repay the policy loan until the loan is paid off.
So not only do we have the lower interest rate, but we also have control over that payment amount every month. So if you run into cash flow problems, you could back off on that payment. But if you are cash flush, you could pay that debt off faster, and you're actually building an asset for yourself.
So another way that you could access that money either in the early stages of your policy or the late stages is to borrow against your cash value to make an investment, whether that's into stocks and bonds, cryptocurrency, gold or silver, or even real estate. And we've previously we have done other videos showing how you could actually borrow against your cash value in your life insurance to increase the rate of return on your real estate investments. So again, the key is using the cash value in your life insurance policy to make your other money much, much more efficient.
Only in a whole life insurance policy could you have access to the cash values without draining the tank. So basically, you're able to continuously earn compound interest and access that money to make an investment that will potentially earn you a higher rate of return. So you have the policy earning the 3 to 5% over your lifetime, but you also have the ability to earn a higher rate of return on investments like stocks or real estate.
And again, as we said earlier, whether it's to make an investment or to pay off debt, the bottom line is that you're making your money more efficient. Your money is working in more than one place at once, and that, again, makes your money more efficient and ultimately puts you in a stronger financial position. So many of you out there might be thinking, well, I could do the same thing with a margin loan, or I could do the same thing by borrowing against the equity in my real estate. And that's true. However, whole life insurance is the only funding mechanism that you could access money and know for sure that you're going to have a greater account value at the end of the year than you did in the previous year. With a margin loan, you might have the underlying investments might decline and you may have a margin call, again, putting a further squeeze on your cash. Or in real estate, the value of your real estate could appreciate, it could depreciate. It depends on the market conditions.
And not only that, with a real estate loan, you have a structured repayment versus with a policy loan, you determine the payment terms in the sense that if you want to put $50 a month on the policy loan, you could do that. If you want to put $300 a month on the policy loan, you could do that. If you don't want to put anything on the policy loan, you could do that. There's no one telling you what the repayment schedule is. And here's another thing to consider. What if you just drain your savings to make the investment? What's the difference there?
So we just had a situation with a client who started a policy. They had about $5,000 of cash in the policy. They coincidentally have a $3,500 credit card bill that's due that they wanted to pay off the credit card. The husband wanted to borrow against the policy because he sort of understood the concept, and the wife was a little hesitant and wanted to use money from their savings account. They had $20,000 in savings, and she said, well, let's just take $3,500 from the savings, drain down the tank, and then we could leave the money in the policy to use for home improvements. Well, what they're missing there is the fact that before that transaction, they have access to $20,000 that they own and control. If they drain down the tank to the tune of $3,500, they don't control $20,000, they only control $16,500. And they're still earning the interest in the policy because they didn't access the money. But if they don't take the money out of savings and they borrow against the policy, they'll still control $20,000 and they'll still earn interest on the $5,000, even though they use $3,500 of it.
That's what we call opportunity cost. We don't only consider the money that we're using, we also consider what that money could have earned us had we invested it.
So whether it's to pay off debt and pay a lower interest rate against the policy versus credit cards, or whether it's to make an external investment by accessing the cash value in your life insurance could generate that external rate of return and still guarantee that you'll get the internal rate of return on your cash value.
If you'd like to get started with a whole life insurance policy designed for cash accumulation, be sure to check out our website at tier1capital.com to schedule your free strategy session today. Also, if you like this video, please be sure to give us a thumbs up and don't forget to subscribe. Leave us a comment down below, let us know what you think and what videos you'd like us to cover in the future.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters.